This one house beat the stock market S&P 500 returns by 5.13x. And in this video, I'm going to share the breakdown of this deal, of this rental property, and the numbers and how it all happened. So let's walk through it. I bought this house in September of 2022. Okay, I'm filming this in 2026. And when I bought this house, between the down payment and closing costs and the rehab, I put in about $22,300 into this deal to get this house and to get it rent ready so a tenant could move in. Today, all in all, it's made a return of about $104,079. So this is a single family home. This is an investment property. I've never been to Ohio. I've never been to Cleveland before, and I purchased this 100% remote. And here's the breakdown of the numbers. So the capital into the deal, the purchase price was $60,500. We actually got it down about $5-6 grand or so. I put 20% down plus closing costs, which came out to about $16,000. The rehab was right around $6,300 to get it rent ready. It didn't need very much. It just needed some cosmetic updates, some new paint, some stuff with the flooring, some fixes with the appliances, and so my total capital in this deal was $22,300. Cash flow from this: when I went and found a tenant, we rent out to Section 8 tenants because we get higher than market rates. In this area, at the time when I was looking for tenants back in 2022, I think the market rate was around $1,000 to $1,050. But because we rent out to Section 8, we get 20 to 50% higher rents, and they're government guaranteed rents, or at least a portion of it is, meaning every month the government will send you a portion of the tenant's rent. So the total rent that we got approved for is $1,490, and in this particular case, they are covering 100% of the tenant's rent, so it's 100% guaranteed. The entire $1,490 is coming directly from the government in the first few days of every month. So we like Section 8 tenants because we get that higher than market rent, and we get the government guaranteed rent. In this case, it's 100% guaranteed. So we're getting higher rents on a cheap house. You can see here it's a $60,500 house, and the rent is $1,490. We're far above that 1% rule that a lot of investors use. With Section 8, because I know this area and because I know what you can get, I look more for 2% rules. So I want the rent to be 2% or higher of the purchase price, which we're hitting here. Mortgage and interest payment on a monthly basis is $259. The property taxes comes out to about $114 a month. My insurance plan is $78 a month. Repairs and CapEx budget, this is just money we set aside. Every month I typically just account 10% of whatever the monthly rent is towards this. If you don't use that budget throughout the year for any kind of repairs or maintenance, then we just put that directly back into our pocket. But we have a budget set aside every month, which is 10% of the rent, just in case we have those things pop up. Water and sewer, we put about $150. Depending on the tenant, sometimes it's less, sometimes it's a bit more, but this is a good average that we use. And so the net cash flow on this particular deal is $740 a month. This is after all expenses, and I'm self-managing this property, so there's no property management fee. If you do use a property manager, you'd subtract another $150 because it's typically 10% of the rent. Okay, so it's still cash flowing very well if that were the case. So the net cash flow a month, $740, cash on cash return is 39.82%. This means I'm getting an annual return of 39.82% on the amount that I invested. So this is just taking this number here, multiplying it by 10, and dividing it by the total capital you have in the deal. Okay, so really strong cash flow. If you tell any other investor, like, hey, I'm getting a 40% return, right, on the cash flow on this property, most of them are going to be like, what are you doing? I want to know what you're doing, okay? Because 40% return is really good. Now, as far as gains go, the appreciation on this property, I actually got an offer in May of last year in 2025 at $130,000. I don't know if we would have ended up there if he did like an inspection or whatever, and I actually went to sell it. He probably would have beat me down on price a bit, but it's right around, I would say 126K is the current value of the home, just based on comps and based on like the offers that I've gotten. I've gotten 2 offers for this home, right around that 120 to 130 range. So the appreciation, we're using 126. The appreciation from 60,500 in the time since I bought this is $65,500. So it's more than doubled in value from when I bought it. And the principal pay down, as we're going through and the tenant's paying this $1,490 a month, a portion of this goes towards paying down my mortgage on this home, right? A big chunk goes to interest, but there is a portion that goes towards paying down the mortgage. So principal pay down over the last 3 years, or since I bought it in September of 2022, is roughly $4,200. Tax savings. This is going to be a separate video on different things that you could do with tax for real estate. But tax savings is around $14,399. We did what's called the cost segregation study, and we've done a few other things with this property in my portfolio to save on taxes, but we'll talk about that in a separate video. Cash flow in that time frame as well from when I purchased is right around $19,980. So these are the gains over time. This is how we get the total return of $104,079. My investment into this to get into this deal was again $22,300. That includes the down payment and the closing costs and the rehab that we did. And the maintenance that we've done over time, it's been within this range. I take some of that repairs and CapEx budget and maintenance and put it towards the things that we've done. There hasn't been very much. There's maybe been like 2 or 3 incidents over that time frame. And they haven't been very big ones. So total ROI on this particular home, 466.7%. The return multiple is 4.67x on my money. So I invested this amount and I made 4.67 times that back on this investment. Okay, so over this same time period from September 2022 to February 2026, the S&P 500 grew by roughly 91% if we're also including reinvested dividends. So that's an exceptional performance. That's not like normal. It doesn't go up by 91% every 3 to 4 years or so. So just for context, if we took the $22,300 that I invested into this property and I put it into the S&P 500 instead and set it so that the dividends that we made from investing were reinvested back in, it would be around a 91% return over that same time period, which again is exceptional. And that $22,300 would be worth around $42,593 today. So that would be a gain of about $20,293. So if we look at the total returns on this particular property, it's between the cash flow appreciation, principal pay down, and tax savings, it's around 104.79. And with the S&P 500, we have 20,293. So even with the exceptional performance of the S&P 500, the returns on this property beat it by 5.13x. The returns from this real estate deal are 5.13x higher than the returns would have been from taking the same amount of capital and putting it into the S&P 500. Now, not every deal is a grand slam with this exact same type of return. And I actually wouldn't consider this a grand slam deal. It's a very good deal though. I have some that are worse where the numbers aren't as good, but even if we cut this in half, it's still pretty solid, right? If we're beating the stock market by 2x instead of 5x, that's still really good. So I have some that are worse and I have some that are actually a lot better than this because I have no capital left in the deal and it still cash flows very well. So if you know what to look for and you're working with the right team, finding good deals consistently is a lot easier to do than if you were to do it alone and try to figure everything out yourself. After I figured things out, I spent a lot of time just going through and learning things, a lot of it the hard way. Once I figured out what I was doing, I had a process and I had built a team, I switched over. I used to be primarily a dividend stock investor and crypto. I switched over to being primarily a real estate investor. I put most of my capital that I was setting aside for investing into buying real estate and developing real estate. So here are 5 reasons why I choose real estate over stocks now. Even though it's not as passive, everyone always says you go into real estate for passive income. That's not really true in my opinion, in my experience. It's not truly passive. The only thing that's truly passive, and this is something that the stock market has over real estate, is I would say stocks are pretty passive because you can put money in. But it doesn't make it the better investment in my opinion for the reasons I'm about to share with you. So here are 5 reasons why I choose real estate over stocks now, even though I'm still in both. Number one is you have cash flow that you can use today. So real estate isn't just about waiting for the value to go up. When you're going into stocks, unless you have dividends, you're waiting for that stock value to go up. And if you're a trader, maybe you're selling the stock at that time and you're triggering a taxable event. But with real estate, you're not just waiting for the value to go up. That's an extra benefit, but you're getting paid rent every month. And if you buy correctly, you're making a profit, you're making cash flow every month from these rent checks that are coming in. So you get paid rent every month, whether the market is up or whether it's down. Doesn't matter. Like if you look at your house right now, especially if you're renting out to Section 8 tenants, doesn't matter if your house is worth, like let's say the real estate market's really good today and your house is worth $150,000. And maybe in a couple of months the market tanks for whatever reason and it cuts the value of your home in half to $75,000. Well, if you have a Section 8 tenant in your house and you're getting paid rent, that rent payment doesn't change. You're still getting cash flow every single month. So that's why I like Section 8 tenants as well. You're getting government guaranteed rents that are 20 to 50% above market rate. So with stocks, if you choose the right one, you get paid a dividend. Not every stock has a dividend that they pay out to their investors. And these dividends are often 2 to 4% yield. But because of that, because the yield's so much lower than like the 40% that we've seen with the cash flow on this particular property, you need significantly more invested to get the same type of cash flow as real estate. So for example, let's say that you wanted to make $10K a month from dividend stocks, okay? And you have a 4% yield on your dividends. You'd need $3 million to make $120K a year or $10K a month, okay? So you need significantly more money invested, and you wouldn't need $3 million in liquid capital to buy a portfolio that gives you $10K a month in net cash flow. So you need significantly more invested into stocks, into dividend stocks versus real estate to get the same type of cash flow. With real estate and the cash flow that you get from the rental income, it's income that you can actually spend and use today. And you could use that on your lifestyle, or you could just roll that into other deals, into your next deals, which is mostly what I do. I just take it and I keep buying more properties and buying more assets until I've reached a level where I'm happy with the cash flow that's spitting out and I could just live solely on that. Okay. So number one, the biggest reason that people probably think of is the cash flow that you can use today. Number two is you have appreciation from your properties that you can use without selling your properties. Okay. So when a stock goes up, you usually have to sell it to realize the gain, and that can trigger taxable events. When a property goes up in value, I don't have to sell it to benefit from that gain. So I can use the equity through a cash out refinance and get access to that equity through a cash out refinance. So let's use the above deal, the first house that I shared, as an example. I bought it for $60,500, okay? And the current value is around $126,000. So through a cash out refinance, I can get 75% of that new value back, which is going to be $94,500. I can pay off the old loan, which is roughly $44,200, and have $50,300 to use for the next deal while still cash flowing on this deal here. So we're going to have a new loan of this amount. It's going to pay off the old loan, and because we're getting that $1,490 a month in Section 8 rents, we're able to pay off the old loan and pay the mortgage, the new mortgage, and still be able to cash flow. It's not going to be the $700 plus a month, but we're still getting in the ballpark of $300 to $500 a month. I haven't actually run the numbers because I haven't done this yet. So this lets me refinance. I can pull the capital out and I can use it as down payment or a cash purchase on the next deal. Or if I just need the cash to use for something else, I could do that, right? As long as we're still cash flowing, I'm going to refinance, or I have the option to refinance and pull my initial capital out at the new value, at 75% of that new value. Okay, so we can use this appreciation and this equity without selling the asset. Number three is your tenant pays down the mortgage every month. So every month, and a lot of people forget this, but a portion of your tenant's rent goes towards paying down the mortgage balance. Yes, a crap ton of it goes towards paying down or paying interest, but there is a portion that goes towards paying down the principal balance. So this is a benefit that a lot of people forget because they're really focused on just the cash flow and the appreciation. But this is like a forced savings account, and it quietly compounds over time because that principal balance is going down over 20 or 30 years, however long your loan terms are. So this is another thing that people don't always think about, but that's happening every time that you get a rent payment. It's going towards, or a portion is going towards, paying down the principal on your mortgage. So that's number 3. Number 4 is you get to control a bigger asset with less cash. And this is kind of what I was talking about earlier. This is a really big one here. With stocks, you control what you buy. If you buy $100,000 worth of stocks, you control $100,000. To control a $100,000 property, though, you only need to put down $20,000, right? A 20% down payment. But you get the upside on the entire asset. So this is why real estate returns look a lot bigger, because you get control of an asset that costs a lot more than you put down. So it's not a one-to-one thing like when you buy stocks. You're controlling more than what you paid for. And when you're looking to build wealth long-term and get access to a lot of assets without needing the exact amount of capital to buy everything 100%, well, you get that control over a larger portfolio. And control is better than ownership if your goal is to build up that cash flow and build up wealth with multiple assets in real estate. Okay? So as opposed to stocks, you buy $100,000, it's like a one-to-one thing, right? You buy $100,000 worth of stocks, you control $100,000. With real estate, you can pay a portion, a smaller percentage, and get access to a much bigger asset with less cash. Number 5 is you get tax advantages that stocks don't get. With stocks, you pay taxes on the dividend gains while you own them and capital gains while you sell. So dividends, if you collect the dividends and you use them, it's going to be rolled into your income and you get taxed on it with your income. And then capital gains when you sell. So with real estate, rental income is taxed, but depreciation can help to reduce that taxable income while the property is still cash flowing. So they can both generate the same amount of income. Stocks and real estate can generate the same amount of income, but they can leave you with different after-tax results and different amounts after tax. So stocks, again, they're taxed when they pay you in dividends and when you sell. Real estate can lower taxable income while it pays you. So even though you're making money, you're making cash flow, you could still lower your taxable income through depreciation. So with real estate, you're often keeping, in my experience, a lot more of what you earn if you know what you're doing and you know your way around the tax code when it applies to real estate. So make sure you get yourself a good CPA and a good tax advisor. I can make an intro to mine if you're working with us as a client. So all this being said, not every deal is a grand slam, right? Every deal is different and you have to know what to look for. You have to know what you're doing. And the biggest thing that I found is you have to make sure, especially if you're doing this remote, which I do, you need to make sure that you have a solid team in place to make this as passive as possible. It's never 100% passive, but you want to make sure that you have a good team in place so that you don't lose your butt and you can make this as passive as possible so that this is not your full-time job. So that's what we help people with. We help out-of-state investors who want to invest in this same market, in the Ohio market. We have a really good team there, and we have a done-for-you service where we help clients to build remote rental portfolios that cash flow $500 plus per property. So if you've got at least $30K to invest and you are a high income earner, typically all of our clients, they're earning $200K plus per year, and you want a shot at beating the stock market similar to deals and with assets like this, real estate assets that pay you every single month, we have a done-for-you service and we could do most of the work for you. So go to primedoorpartners.com. It's going to take you over to a page that will have a short explainer video showing you how it works. And then you can book a call. You'll speak directly with me. We'll map out a plan and see how this can work for you. Okay. So I hope this was useful to see how real estate can actually beat stock market returns and the different ways it can do that. And I hope this gives you something to think about on why you should be buying and getting into real estate as well. Okay. Hope you like this. I'll see you in the next video.